Happy Friday, IHMC friends and family. It's Shayan with Integrity Home Mortgage, back with your weekly mortgage market commentary. It's usually March that's in like a lion and out like a lamb, but it's a much more appropriate way to describe May this year. May has not been kind to interest rates overall, but we're wrapping up the month on a much more constructive note for bond markets. Mortgage prices have closed higher every day for the past 6 days, and we look to be on track to make today day number 7. What's behind the rally is a gradual shift over the course of the month, which started with a risk on tone fueled by optimism around trade relations with China and is ending on a more risk averse tone on a combination of economic concerns. So I'll touch on three major ones today. What is weaker economic data? To highlight just a few points from this week, signs of cooling off in home prices, negative GDP growth, and an uptick in jobless claims. Details on all that stuff can be found by clicking on the economic calendar below here. Number two is the Fed, right? Data is weaker, but not like panic-inducing weaker. And the fact that inflation numbers have not moved higher despite the tariff concerns means that the Fed is free to remain on hold and won't be come to the rescue of markets anytime real soon. And number three, speaking of tariffs, is tariff uncertainty, right? The sharp increase in imports in Q1, which built up inventories prior to tariffs going into effect, and the shifts and delays in tariff policy are the reason those impacts haven't yet come through the data. But markets are still bracing for when they do. There's a back and forth on the legality of the administration's tariff actions, with courts ruling actually in both directions this week, with a potential appeal to the Supreme Court in the making. And an apparent setback in trade relations a couple of hours ago trade relations specifically with China a couple of hours ago has equity selling off and mortgage rates at their best levels of the week right now. So we continue to be in an environment where bad news equals good news, right? Bad news for the economy is good news for bond markets. So all of this uncertainty has shifted sentiment towards seeking out safety. Treasury yields and mortgage rates have benefit as a result. The worse the news is, the more likely it becomes that the Fed cuts rates earlier and more aggressively. Now, that's not always true, but it's a general rule of thumb. One notable exception would be inflation, right? Bad news, meaning higher inflation, would leave the Fed with a tough choice in their hands of which mandate to prioritize, inflation or jobs. Given the historically low unemployment rate and overall resilience in labor markets, if it comes down to it, I think it's a pretty good bet the Fed would opt to raise rates to battle inflation, even if it meant sacrificing growth and a few jobs. So speaking of jobs, next week's economic calendar is full of jobs data, and it'll be the Fed's last look at labor markets prior to their next meeting on June 18th. Expectations for the Fed to remain on pause are basically 100% right now, and for there to be about 2 cuts by year end. While that's not much changed from last week, keep in mind a month ago we were pricing in between 4 and 5 rate cuts, and a high probability of those rate cuts starting this month. We've been saying it for months now. To us, 4 to 5 rate cuts this year was an insane assumption. And we frankly still think 2 is aspirational. So the bottom line is take advantage of these better rates when they come available, all else being equal. As expectations for the Fed go down, rates will be pushed up. That's all I got for you this week. Thanks a lot. I'll see you next week.